Awesome. Well, we'll go ahead and get started. Looks like we've got about 25% of all of the participants registered already on. So people, I'm sure, jump in as we get going. But thank you for everyone that's joining. Thank you so much for joining us for this second installment of our webinar series, Capital Solutions. And we are excited to have Alex with us today from the Pew Charitable Trust to talk to us about the path to a stronger consumer protection under the incoming Biden administration. This is such a relevant conversation for so many reasons right now, as in light of everything that's going on in our country. It seems like the list is getting longer. It's so important for us to have these conversations about public policy, legislation at the local, federal, and state level, as well as how we can advocate for ourselves and our fellow Americans. So now that we voted, we the people have spoken, and now the work that we all do continues as we continue to fight for those consumer protections and good public policy. I am your moderator today, Aisha Bussey with Capital Good Fund. And joining us, we have Andy Posner from Capital Good Fund. I introduced myself, Aisha Bussey. I'm the Vice President of Communications and Business Development with Capital Good Fund, and Alex Horowitz from the Pew Charitable Trust. So thank you both for joining us. This is going to be a great conversation. And now I'll turn it over to Andy and Alex to talk a little bit about Capital Good Fund and the Pew Charitable Trust. Take it away, Andy.
Thank you so much. And Aisha, how did you want to handle folks asking questions?
Yes, thank you. A few housekeeping things. This is being recorded, just so that you're aware. The recording will be posted to our YouTube, as well as a link will be shared with you all after the webinar in the next coming days. There is a Q&A section. We'll leave about 10 to 15 minutes at the end of the webinar for questions, but we do want this to be as interactive as possible. So if you have questions throughout the webinar, please feel free to throw your hand up, unmute yourself, or just throw a question in the Q&A section, and we'll get those asked as we go on. And I think those are all of the main things for the housekeeping. If you do have any other questions, please feel free to email me or Alex or Andy at the end if there's a question that we didn't have time to answer, or if you think of something later. And we'll be putting our contact information at the end of the presentation.
Wonderful. Thank you, Aisha. And thank you, everyone, for joining, spending an hour with us. Look forward to this conversation. Want to dive into the conversation as quickly as possible, but just a quick overview about Capital Good Fund. We're a nonprofit. You can see here we have a U.S. Treasury certification. We do three things. One is small dollar personal loans that are meant to be an alternative to the kind of predatory loans that we'll be talking about in this discussion. The second thing we do is financial and health coaching, all of which has a credit building component. And then we also do advocacy. So we consider ourselves a direct service provider plus advocacy. And we're going to talk in a moment about a big victory we just had in Illinois on the consumer protection front. And we operate in 6 states, and we use financial services to both address poverty and advance a green economy. Next slide.
Thanks, and thanks, Aisha. Thanks, Andy. Nice to be here, and thanks everyone for joining. So at Pew, we have a project that works on consumer finance, and I should flag also, we just launched a new project this past year that works on home financing as well. So we've got a new issue area that I'm one of the folks working on, looking at especially small loans to buy homes and non-mortgage loans that people use to purchase homes, both site-built and manufactured. So in our small loan work, we have been doing analysis for almost 10 years of the payday, car title, installment, and bank small loan markets, and the substitutes that people use for those. We've focused on both problems and solutions in those markets, looking at loan markets that are working well and those that are working poorly, and what are the obstacles to better loans coming to market, and situations where markets work well and serve consumers and give them good choices and promote competition, and markets that fail. where prices end up being unnecessarily high, where payments end up being unaffordable, and regulatory and legislative reasons why we see successes and why we see failures, and why some of the normal dynamics of price competition have not applied to this market. We've developed recommendations for how to make loans much safer. That includes loans from banks and credit unions. It also includes loans from payday lenders, from title lenders, from installment lenders. So kind of sidestepping the question of whether there should be high rate loans or not, but looking at unaffordable loans versus affordable loans, and how do we solve problems with unaffordable loans, and how do we promote access to affordable loans. We also provide assistance to state policymakers and federal policymakers, that's both regulators and lawmakers, as well as to providers like banks and credit unions and other non-depository lenders on developing affordable small loans. And we've been excited to see some of the terrific developments in recent years with small loans coming to market and reaching consumers who otherwise wouldn't have qualified in the past, from US Bank and Bank of America in particular, which have launched affordable small loan programs and provided access to people who have a checking account, but previously were stepping outside of the banking system to borrow. So you can see some of the couple screenshots from our website at the bottom: animations, briefs, surveys, reports, fact sheets, infographics that we've developed over the years. Thanks very much.
Awesome. And we already have our first question. This is exciting. Did you all investigate property tax lending? Alex, that one's for you.
Great, thank you. I am aware of property tax lending just through news stories I have read about it. That is not an area where we have done any work yet. On the home lending side, we've been looking at small mortgages especially, and why there has been a truly mammoth drop-off in small mortgage lending in recent years. And by small, I mean under 100,000 and even under 150,000. There's been a very large drop-off in small mortgage lending, but there are lots of parts of the country where a home can be bought for that amount, but affordable financing is awfully hard to find. And also looking at non-mortgage loans that people are using to buy homes: chattel and personal property lending for manufactured housing, and contract for deed, land contract, rent-to-own, lease option for both manufactured and site-built housing for relatively low-cost homes when small mortgages do, when they're available, have lower rates and stronger protections.
Excellent. Thank you so much, Alex. Andy, I'll turn it back over to you.
Wonderful. So I thought I'd just level set a little bit about why are we even talking about public policy? I mean, fundamentally, Capital Good Fund is a direct service provider. We do loans and coaching, like I said. And really what we've learned over the years is that you can't fulfill your mission, whatever type of nonprofit you are, whether it's arts or job training or financial services, without public policy. I mean, for example, let's suppose that you are a food bank trying to end hunger. You can never provide enough donated food to feed everyone. If the federal government were to increase the minimum wage or make housing more affordable, or just increase the food stamps or SNAP benefit program, that could have tremendous impact. And it doesn't obviate the need for the food bank, but the two have to work in concert. So in our case, I think Illinois is a fantastic example. So I kind of teased this victory. In many of the states in which we operate, payday lending is legal. Illinois is one of them. And we just played a really important part. We were part of a coalition of advocates that advocated for capping the interest rate on payday loans, auto title loans, and the like at 36%, and it passed. This is a huge victory. This does not happen often. The industry has an incredibly strong lobby. We got it through, and the governor is going to sign it. And you can see that currently a payday loan averages almost 300% in Illinois, and an auto title loan 180%. So now those companies are either going to have to lower their rate to 36% or shut down. Now, one of the reasons that we were important in this discussion is because legislators always ask, okay, if we do this, if we get rid of these incredibly harmful lenders which target communities of color and other vulnerable groups, where are people going to go? The fact that Capital Good Fund has an alternative product is essential. But again, we're too small and we could never meet the demand unless legislators also protected consumers from harmful practices. And so that's why we're putting such an effort on our end into advocating for public policy, and why we enjoy having conversations with groups like Pew, because they're really the experts in that area. So next slide.
Excellent point, Andy. In Illinois, I think we're all still smiling about that victory, and kudos to you and the entire Capital Good Fund team for playing such a pivotal role in that this week.
Yeah, and I'll just note, it passed on a bipartisan basis. It was unanimous in the House in Illinois, and it passed like 35-9 in the Illinois Senate. So this was just huge. And it goes to show what advocacy can do to protect consumers. So take it away, Alex.
All right, thank you, great. So to look at spending, consumers spend a lot of money on fees and interest for very, very expensive loans in small denominations. So we're looking at about $9 billion on payday loan spending. By payday loans, I mean loans that come from payday lenders. That market has shifted. It used to be predominantly single payment loans. And now we're seeing a lot more payday installment loans, still generally with interest rates in the 300 to 400% range, and payday lines of credit. So something that works like a credit card in that it does not have a pathway out of debt. Payments do not necessarily pay down principal, but it carries interest rates that are generally in the 200s and 300s and often have a draw fee as well. So that's annual spending on payday and similar loans from payday lenders. Another $3 billion or so to auto title lenders. So these are larger loans than payday loans. Auto title loans average about $1,000 versus $375 or so for payday loans, and are typically for a 1-month term, although that market also has been migrating toward title installment and title lines of credit, depending on the state and the statute where interest rates that high are allowed. Another $10 billion or so on subprime installment. So by this, we mean non-bank traditional installment lenders that charge rates that are lower than payday and title lenders, although higher for the small loans than what we are seeing from banks like US Bank and Bank of America that have entered this market, and where other banks could be profitably if they chose to make affordable small loans to their customers who already have checking accounts with them. Another $5 billion or so on pawn. Pawn lending is in all 50 states, and similar amount spent on rent to own. Rent to own is in all 50 states. And another 11 billion plus to large banks in overdraft fees, averaging about $35. So an awfully expensive form of credit, especially because about 5% of checking account holders overdraft 20 plus times per year. At $35 a pop, this is a very, very expensive form of small credit. And in the payday lending market, we see about 12 million Americans using these loans annually. And the average borrower pays more in fees than they originally got in credit. So about $520 in fees to repeatedly borrow $375 in credit for 5 months or so of the year. A typical loan due on the borrower's next payday takes up 36% of that borrower's next paycheck. This is a big bite out of someone's paycheck. Most borrowers cannot afford to repay and cover their expenses, so they take another 2-week loan. The same problem occurs in the auto title loan market, where an auto title loan takes up 50% of a borrower's monthly income if it's due in a 30-day term. So repeat borrowing is the norm in these markets, not the exception. A typical borrower makes $30,000 a year. If you envision someone working full-time, that comes out to $15 an hour. So not someone who is necessarily below the poverty line, or people who are extremely poor, but often working poor, working class, because all borrowers must have a checking account in order to secure the loan. So we're not talking about the 5.5% of households who are unbanked. We're talking about triple that number who are underbanked, meaning they have a checking account, but they're stepping outside of the banking system to meet some of their needs because they're not getting them met inside the banking system. There are payday loans in 34 states. That number was 36 when we started this work. Nebraska and South Dakota have since gotten rid of payday lending by ballot initiative, and auto title loans in 22. That number has dropped from 25 when we first published a report on auto title lending about 5 years ago.
And if I can just add two things quickly. The first one is, let me just give an example of how pernicious these are, or a little more detail. If you look at those $3 billion in auto title loans, they're basically like a line of credit against your car. You give away the title to your car, and in about a quarter of cases, it results in a repossession. So either you pay off the loan and you're paying that 100+ APR, or you default and you lose your car. So very, very damaging. The other one is, if you look at our a loan from us at $375, you're going to pay about $10 in interest compared to the $520, and you're going to build your credit because we report to all 3 credit bureaus. So we estimate we've saved our borrowers $5.6 million in interest and fees over the years. So that's money in people's, for food on the table, for school supplies, the utilities, rent, etc.
Wow, congratulations, that's a big number.
Thank you.
Great information, Alex. I personally have never thought of overdraft fees as lending. So that was very interesting to hear that on this slide. We do have another question in the Q&A. Where would you put buy now, pay later companies that are in such demand that many of the companies are going public, i.e. a firm, and making this type of lending mainstream? Great question.
Yeah, that is a great question. And so buy now, pay later, just for sort of clarity. So we're not talking about kind of buy here, pay here, deep subprime auto loans, but loans, or I probably shouldn't say loans, because there are legal questions about that. But agreements where a borrower purchases an item and then repays it, usually in 4 installments. Some of there are companies like this that have a variety of terms and conditions, depending on whether someone pays as agreed, pays late, and some have an interest rate, some use fee policies. These are, I'd categorize these as being certainly different than payday and title loans, in that, frankly, in dollar terms, they cost a lot less. And these are purchase money loans. So it's probably worth thinking about products like this as being a better comparison to rent-to-own agreements than to cash loans. So for example, the CFPB rule in 2017 that was finalized and has since been rescinded did not cover purchase money agreements or loans due in multiple payments with terms more than 45 days. So did not cover, rent to own, did not cover pawn, and did not cover buy now, pay later agreements like this, which are, small, really are effectively small purchase money loans.
Thank you. I will share again here. And I will move us to the next slide.
Great, thank you. So I think this is fascinating. I wonder if others do too, because we see the same payday loan chains operate throughout the country. There are states where independent lenders have a meaningful market share, but chains are dominant. Multi-state lenders often operate 2/3 or more of stores. We've seen states where multi-state lenders have more than 90% of market share. And the same companies operate across the country, but they do not charge the same prices in every state. But credit is widely available in states like Colorado and Ohio that you see here, from the same companies that operate in states like Delaware and Illinois and Texas that you see here. What's different is the price they charge, how long they give borrowers to repay, whether the loan takes up 4, 5, 6% of a paycheck, or 34, 35, 36% of a paycheck. And we see dramatically different results and different prices, but from the same companies, making the same size loans to similar borrowers. And there's very clear data from before and after law changes in states like Colorado and Ohio, and most recently Virginia, where loans are still widely available to the same types of borrowers from the same companies in the same amounts, but they cost 3, 4 times less. We see affordable payments. We see much better consumer outcomes. And so there's been this false choice between 300, 400% APRs or access to credit, when it's entirely reasonable for states not to have payday lending, like Massachusetts that you see here. That is a perfectly reasonable policy choice, and there's reason to believe that that serves consumers well compared to these states like Texas that you see here. But if states want to have access to credit, and they want to have better consumer outcomes, they can just have both. You don't need to choose. Consumers in Colorado and Ohio still have access to credit from the same payday lenders that operate in Illinois and Texas. They just pay a whole lot less and have much, much better outcomes. So why does this happen? Well, in a normal market, your customers are price sensitive and they shop around, and lenders compete on price. And you'd have lenders out there trying to underprice each other. Say, demonstrate that they offer more affordable payments, give borrowers more time to repay. In a market like this, lenders know that their customers are in financial distress, that they've got a bill to pay today, tomorrow, there's an emergency. And so we see that borrowers are sensitive to how much they can borrow, how quickly they can get the money, if it's a sure thing. They're not sensitive to price and affordability. And lenders are well aware of that. And even if there are a small number of borrowers who are sensitive to price and affordability, lenders tend not to compete on price and affordability. And they charge the ceiling, however high it is. And that's why the same company will operate in Texas and charge more than 9 times what they're charging in Colorado for the same loan, making it to similar borrowers.
Thank you. We have another question. What are opportunities and priorities with a Democratic Senate? This is for both of you.
So we're not doing federal legislative work, but the Congressional Review Act is a tool that is available to Congress to overturn regulations finalized late in a previous administration. And Congressional Review Act resolutions, they pass like a bill, but they're easier to pass than a bill. And they can be used to overturn regulations finalized late in an administration. So as an example, the Office of the Comptroller of the Currency recently finalized a very broad true lender rule that would determine that banks are a true lender, even if they just fund a loan, or even if they put their name on the origination and then immediately sell the loan to a high-cost lender, making a loan that would otherwise be illegal under state law. So a rule like that could be overturned by Congress because it was finalized recently. and it raises very serious consumer protection concerns and undermines state laws. So if regulators don't withdraw, rescind a rule like that, it would be subject to Congressional Review Act action, and Congress could overturn it. And that would have the effect of strengthening state laws and strengthening consumer protections, because it would take away this new tool, this new true lender tool that the OCC just finalized to make loans that would otherwise be illegal under state law.
And I think from our perspective, while this isn't something congressional Democrats can or Congress can deal with or address, we'll be keeping a close eye on the Consumer Financial Protection Bureau, because as we've already alluded to, in 2017, they rescinded a rule that had been proposed under the Obama CFPB that, among other things, would have required small dollar lenders to do an ability to pay test. So believe it or not, right now, these lenders don't have to do that. They don't have to ascertain whether or not a borrower can afford the loan that they're making. CFPB, I don't believe, has the ability to regulate rates, but just by promulgating that rule, they could do a tremendous amount of good, because a lot of these lenders wouldn't be able to make these loans because their borrowers can't afford the loan. And that's actually how they make money, by trapping them in a cycle of debt. Beyond that, I mean, I think what Alex is mentioning is that a lot of the regulators, I mean, they've been trying to make it easier for banks to do so-called rent-a-bank schemes to basically, get around these state prohibitions on usury. At the same time, anything that bears on getting money into people's hands during this pandemic will reduce the amount of predatory lending. Right now, a lot of people are going to payday lenders and the like because their income is down, the enhanced unemployment had expired, now it's been renewed. The stimulus payments have been pretty inadequate. So anything that does that or increases the minimum wage or really gets the economy open again by dealing with COVID is going to also protect people indirectly from payday lending and the like.
That's a great point. There was a very large drop-off in payday lending volume this past spring after the CARES Act passed. And so when the CARES Act passed, that meant that households or individuals earning up to $75,000 received a $1,200 check. More than 90% of payday loan borrowers earn less than $75,000. So that is a population that would receive that check. And also a lot of the expenses that people normally have, there were the consequences for non-payment of bills became less severe. With the eviction moratorium, some utilities paused shutoffs, there was student loan forbearance, there was some mortgage forbearance. So it's on both sides of the balance sheet. There was additional money coming in this past spring after the CARES Act and with the enhanced unemployment benefits. And then also on the other side, in terms of expenditures, the consequences for non-payment became less severe. And doing focus groups, we've done 22 focus groups with borrowers around the country. And talking with them, we heard borrowers who were strategic around, for example, in cold weather areas where their heat can't be turned off during the winter, or utilities can't be disconnected during the winter. If they couldn't get by otherwise, they didn't pay those bills in the winter and would wait till they received a tax refund. And once they received their tax refund, often including the earned income tax credit, then they would use that tax refund to get caught up on their utility bills before the utilities were disconnected, when the weather warmed up a little bit. So we do see borrowers who are savvy in many ways, but it doesn't mean that they shop around for the lowest prices on loans. And it doesn't mean that lenders compete in terms of price or affordability. And that's why we see this market failure. Whereas that even though we have savvy consumers, they're very clearly in financial distress, and lenders are aware of that and therefore charge the ceiling. So we don't see normal price competition emerging. And if consumers are going to be better off, that does mean either public policy. So the reinstituting the 2017 CFPB rule would be a great place to start. State level consumer protections, and also an increase in affordable alternatives from banks, especially, who are well positioned to offer them. So for just kind of a clear example, how state laws can bring down consumer lending rates without reducing access to credit. You look at Ohio in 2018, a bipartisan legislation passed, standalone bill, and you can see the cost to borrow $400 for 3 months before the law passed was $400 plus. So people would pay more in fees than they got in credit to borrow that amount. After, $109. Some of these same lenders who were there before are still there after, and a couple of lower cost lenders entered the state as well once they had this level playing field. Credit's still widely available there, more than $75 million a year in consumer savings, just on the payday side, doesn't include the title side. Then Virginia passed a similar law in 2020, also on a bipartisan basis, standalone bill. The cost to borrow $500 for 4 months. Before that in Virginia, $480. After, $138. Same credit. You can see it's for the same amount of time, but it costs dramatically less. And we see affordable payments around 5-6% of a paycheck. And the Virginia law also took pains to expand access to installment credit and to welcome lower cost lenders into the state. And so we see lower cost providers who previously avoided a market like this now interested because there's a level playing field and an authorizing statute.
Well, and that last point is, I was actually going to say the same thing, because that's the other piece of this, is that for an equitable lender like Capital Good Fund or other players in the market, it's very hard to compete with a payday lender, because by charging 300% APR, they can pump out loans in 5 minutes because they don't care if their default rate's 40% because they're still making money. We can't make a loan in 5 minutes. I mean, we can do it in 1 day, 2 days, or 3 days. But if you need to fix your car or your utilities are going to be shut off, and we don't have a branch on every street corner at Capital Good Fund, so it's harder to hear about us, you're probably not going to go through the trouble of finding us and applying for a loan with us. Once we level the playing field, though, we become a much more attractive option. And so that's a really, really key thing that people often don't think about, is when you have a broken marketplace, you don't have competition and it's hard to compete, for a lender like us. And so we expect that next year there will be a slide like this about Illinois, where families are still going to have access to credit, but they're going to save hundreds of dollars in interest and fees, which is why we are so proud of that legislative victory.
Awesome point, Andy. We've got a few questions in the Q&A here. Looking at the state comparison cost chart that we previously had up, any thought on the states with the highest fees, Texas and Florida, being perceived as rate outcomes set by the free market? And also any correlation between states with the highest fees having a larger population of people of color, which contributes to financial racial disparities?
Great question. Mm-hmm. So let me handle the racial question first, and then talk about market pricing. So some of the states with the highest prices in the country are Idaho and Utah, North Dakota, and there are other expensive states that are more racially diverse, like Texas. Wisconsin's extremely expensive. Kansas has no rate limit whatsoever on their open-end statute, very expensive. So we see when states don't protect consumers, loans are expensive, regardless of who lives in the state. And there's disproportionate usage of payday loans by African Americans especially. And we do see that assets are important as well as income. So it's not just income. Low-income homeowners are less likely to use payday loans than moderate income renters. So it's not just income. There's more going on than that. It's about safety net. It's about if you have other folks you can call to help you out, and it's if you have savings and assets to fall back on. And there's evidence that that when people have those options, they use them instead of very expensive payday loans. And the other question was about market outcomes. And so I think in looking at market outcomes, yes, that is what a market looks like that does not have consumer protections in it. And those are the results. There are no price ceilings involved that are constraining prices. And I think that there used to be an expectation that price competition would bring down prices. But price sensitivity is a prerequisite for price competition. So if you don't have price sensitivity, price competition doesn't materialize. And the reason given for opposing, say, Colorado's 2010 reform, Ohio's 2018 reform, Virginia's 2020 reform, even New Mexico's 2017 bill, was that if states limit prices for loans, then there won't be access to credit available. And so I like that lenders made that argument because it's an empirical one. It's not an ideological one. It's an empirical one. It's something we can test, we can measure. Okay, let's see what happened. Let's go to the tape. Well, Colorado releases a report with every loan in the state made before the law change and after the law change. There's still a similar amount of credit there, made to similar borrowers. In Ohio, the claim was there won't be any credit here. There are lots of stores open and some new lenders came into the state. Virginia, we're seeing the same result. So it's nice when arguments are testable and when we can see whether the prediction materializes. And that's been the reason for not setting prices, because you'll cut off supply and you will reduce access. And look, there are price points that are so low that that there's not going to be credit available. And that's a defensible policy choice to make. But it's hard to see why consumers are better off without protections and prices that are 3, 4, 5 times higher than when they still have access to credit, but at a much lower price point. And we surveyed payday loan borrowers and said, if half the stores in your area went out of business, but the remaining stores stayed open and charged lower prices, would that be a good thing or a bad thing? Perhaps unsurprisingly, 9 out of 10 payday loan borrowers said that would be a good thing. And when we did focus groups with borrowers in Colorado who used loans before and after reform, they were very, very clear that things were better for them after reform. And from state administrative data, we can see that credit was similarly available before and after.
Wow.
And payday lending branches are disproportionately located in communities of color. So they absolutely target, there's a racial disparity in where they're based and who they're trying to reach predominantly. So this disproportionately impacts the most vulnerable communities and compounds disparities.
Great point. Thank you, Andy. I'll move to the next slide. We do have a few more questions in the Q&A, so we'll answer them as we keep going. Well, I'll ask one more question and then we'll move back on. Are large banks actually involved behind the scenes with payday loan companies? Maybe they even own those companies?
A short answer, no, they do not own those companies. So, I mean, there have been banks that have extended lines of credit to payday lenders. And I think that the kind of most concerning area of bank payday lender relationships is there are a small number of banks who have begun engaging in rent-to-bank relationships, where they originate loans that would otherwise be illegal under state law and then quickly transfer them to payday lenders. Those are mostly FDIC supervised banks. And so those rent-to-bank agreements do undermine state law. And you saw that Ohio law there, the banks who have engaged in these kinds of relationships with payday lenders have made the argument that their loans are better than what's otherwise available. Well, there are rent-to-bank loans in Ohio, and they cost double what the actual payday lenders are charging. So very hard to see the policy rationale for allowing this kind of relationships that have the effect of undermining state law, where a bank nominally originates a loan and then quickly transfers it to a payday lender. That's not good for consumers or households.
Thank you, Alex. Okay, I will go back to our slides and ask a few more questions as we go along.
So what the CFPB can and should do, I agree with Andy, they should reinstate their 2017 payday loan rule. They retracted it without evidence for doing so in 2020. And the 2017 rule was the product of extensive research and discussions with all stakeholders over quite a lot of years. And it was well balanced, and they should reinstate that 2017 rule. The CFPB and federal bank regulators should continue to encourage safe, affordable bank products. The joint guidance from the OCC, Fed, FDIC, and NCUA was good. They should keep it, and that will help give banks the regulatory certainty they need to offer affordable loans in this market, like U.S. Bank and Bank of America are doing. And we are glad to talk with banks about how to do so. And we've had good discussions with banks about how to offer those loans. And the CFPB and the federal bank regulators, and especially the FDIC, should stop rent-a-bank arrangements that avoid state consumer protections that we just discussed. And the regulators should keep an eye out for single payment bank deposit advances. Single payment loans don't work for consumers. It takes up too big a share of their paycheck and they borrow again because the terms aren't long enough.
I think it's also worth understanding a little bit about the dynamic behind that retraction of the payday loan rule, because the only people that advocated that retraction is the industry. And for 3 consecutive years, the Payday Loan Trade Association had their annual conference at Trump Resorts in Florida. And this is just an example of one of the reasons why these kinds of conflict of interest end up resulting in policy that directly harm consumers. And we have to understand these policy and power dynamics when we think about reform. And certainly at the state level, that plays a really important role, like in Rhode Island, understanding who is leading the lobbyist and who are the key touch points in the legislature. That's how the industry works. They understand what are the levers they have to pull, and they often have more money than the advocates do. But if advocates are really smart and understand these dynamics, they can achieve policy victories.
Great point, Andy. And I'll turn it back over to you to talk about Capital Good Fund and what we focus on here.
Yeah, so a little bit about what we're focusing on just quickly before we get into Q&A this year, and as well as what we focused on last year. Obviously, COVID was a big driver of what we were thinking about. And so we launched a crisis relief loan that was meant to help people avoid the need to go to a payday lender and provide some liquidity. These loans were $300 to $1,500. They had a 3-month deferment period and then 12 monthly payments. We were able to offer these at just 5% because we had some grant support behind them. And we served 1,100 families and over 3,000 individuals, given the average household sizes last year with this product. And we plan on doing at least that again this year. And this is really helping people avoid evictions and harmed credit, overdrafts, and all sorts of things like that. And then if you want to go to the next slide. This year, we're really excited because a lot of what we've done over the last 4 years is because we have not really had a federal government that's been looking to enact policy that lines up with the interests of our communities. We've been playing a lot of defense. For example, one of the things that we do is immigration loans. And of course, policies on the immigration space changed the kinds of cases that we were working on, that we were financing. Like asylum basically went away. And so we did not do a lot of lending for asylum. Similarly, in the environmental space, there was very few policy making that was pro-environment and pro-environment justice. So we're really going to be looking at the Biden administration in the next 4 years to enact a much more humane immigration policy that would make it easier for people to become citizens or get their green card or petition family members. People are still going to need loans to afford those fees, but it should be a lot easier. We'll sort of be playing offense and working in tandem with our government. And then in similar vein, on the energy efficiency loan side, we call it our double green loan. Biden has put out a very ambitious policy of weatherizing homes to address climate change and environmental injustice, and also create jobs. And so we look to be at the forefront of that, making sure that low to moderate income homeowners aren't left out of it. Because one thing we're concerned about is as we start to come out of the pandemic, it's going to take a while for the economy to recover. And we're worried about mainstream lenders pulling out of lending in the kind of near prime, low to moderate income home owner space. So we believe we have a really important role to play in serving that market and making sure that people can now weatherize their homes or apply for citizenship or refinance their car. That's always been a challenge, but now it's going to be even more so. And there's a pent-up demand. We didn't do as many of these loans last year because there was so much uncertainty. So there are a lot of people now who didn't repair their boiler or didn't remove mold that they discovered in the house because they couldn't, or because contractors wouldn't come into homes. So there's gonna be a lot of people looking to do that work, and that work is also gonna create jobs for contractors who have not been able to do any work in homes. So we see a lot of opportunity to do good in the next couple of years.
Thank you. And thank you both. This has been an eye-opening discussion, and we have a few more questions here in the Q&A section, so we'll get back to those. Will the person getting a loan be in an emergency or just think they're in crisis mode or a want mode for an item or service?
So when someone applies for a crisis relief loan with us, we certainly factor in what they're looking to use the loan for. For us, the best loan is the one that we don't need to make. And all of our staff, loan officers and underwriters, are familiar with the landscape of programs that are available to people. So if someone applies for a loan to catch up on utilities and we know of a program that would get them on an interest-free payment plan, that's definitely something that we will communicate with the client. But this question does go to a little bit about our core philosophy. And our core philosophy is that poverty is not a function of an inability to manage one's finances, but rather a lack of money to manage. And so, people don't go to payday lenders because they don't know that they're high interest loans. It's because they don't have other alternatives. And so people in the main are not taking out loans or crisis relief loan for, what frivolous expenses, quote unquote. We're very, very non-judgmental about that. And, right now we just see so much suffering and difficulty that, if somebody wants a $300 loan to buy Christmas gifts, when we underwrite that loan, the question we're asking is, can they afford the loan? Are they likely to pay it back? If the answer is yes, and they want that money at 5% for Christmas gifts, that's not our judgment to make. And as Alex has talked about, low-income families are extraordinarily savvy. You have to be to juggle all these things. And we really subscribe to that belief and believe in and trust our clients to use the money in the best way they see fit.
Thank you, Andy. Excellent point. And that's why our work at Capital Good Fund is so important. Let's see. So we spoke about Illinois, Virginia, and Illinois. Are there any other states that we should be watching?
Sure. So there was just the most recent ballot initiative was in Nebraska in November and just taking effect. And so that was that's a strict rate cap ballot initiative, effectively the same as what passed in South Dakota in 2016. And we're keeping an eye on other states where there are bills that are being discussed. There would have been a harmful expansion of payday installment lending in Michigan under a bill which does not look like it will proceed, and that's a positive step because it would have been a harmful expansion. And we're keeping an eye on states around the country. Lots of states have bills introduced almost every session, but they don't often pass. And so when there are victories and states take a step forward, it's a big deal.
of the states in which we operate, now that Illinois has been dealt with, Massachusetts is the only other one that doesn't allow payday lending. So Delaware has no interest rate cap. You can charge whatever rate the borrower agrees to. And then Florida, Texas, Rhode Island all also allow payday lending. In Rhode Island, to Alex's point, for 10 years in a row now, I believe we've helped file legislation to cap the rate at 36%, and it's never even made it out of committee. And that's just a power dynamic that, you know, we'll probably fight that fight again this year, and hopefully we can win. But it is frustrating given the data that we've been providing here in this webinar that Pew has about how it doesn't get rid of availability of credit. It just saves consumers money.
Absolutely. This one's for you, Andy. What are the qualifying factors for the Capital Good Fund small dollar loan, and what is the delinquency and charge-off rate?
Yeah, so we've done 6,200 loans for $13 million with a 95% repayment rate. The average FICO for our borrowers is 580 at intake, and 20% have no FICO. So we're definitely lending to a very similar population, and 90% are considered low income. The key thing we do is first we do a residual ability to pay test, which is what any responsible lender does, and it's what CFPB had proposed as a requirement. And then the most important thing we do is, because our borrowers have poor credit or none, we don't really underwrite on that. We do look at their history, but the most important factor for us is banking history. And keep in mind, you have to have a bank account to get a payday loan. And what we found is that there are a lot of families that their credit was hurt because of domestic violence or identity theft or illness, that when you look at their bank statements, they manage their money extremely well. And when you look at a year ago, maybe they fell behind on some things in their credit, but prior to that, they were current, and subsequent to that, they were current. And so the data, the story often matches the data. And other lenders just don't take the time to do that. They just say, oh, 580, I'm not gonna lend to them. And then they have nowhere to go but the fringe lenders like the payday lender. And so it's worked extraordinarily well for us. I mean, certainly our repayment rate is testament to that, but also it's the relationships that we build with our clients. It's not just like we make a loan and then off you go. We provide additional support, financial coaching is available, but it's kind of good old fashioned sound underwriting.
Excellent. Can an individual go to another state to get the lower interest rate?
Sure, that is something that can be done if you live right near a state border. You know, a whole lot of people don't live right near a state border, and there is evidence that does not happen because borrowers are not price sensitive. So if they're not even going down the street to see if another lender has a lower price, and there's not much reason to go down the street because lenders tend to all charge the same price, and they all charge the ceiling. We do not see borrowers crossing borders to try and get lower prices, and it often would not be cost effective to do so unless they live right near the border, but they will go to their bank if their bank offers them a small loan that is just as quick and just as easy and just as convenient. And that's part of what's promising about the US Bank and Bank of America products. They're faster, easier, more convenient than any payday loan, and they charge much, much, much less. So if other banks were to do that too, we would see customers switch to those banks. And in our survey work with payday loan borrowers, they are absolutely clear. They would switch to using their banks if their banks offered a loan that was just as quick, easy, and convenient as a payday loan, but repaid in installments over a few months at a much lower price point.
Thank you, Alex. A question for both of you. Are you aware of any research on predatory pricing in car loans as opposed to predatory promissory note agreements? I regularly see companies using predatory pricing to keep buyers locked into their predatory loan because they cannot refinance due to being upside down, owing significantly more on the vehicle than the vehicle is worth.
We haven't done work on that. I'm aware of work in that space, and especially on buy here, pay here, auto lending. And I'm also aware of credit unions and CDFIs that will refinance people out of those loans, but I haven't done work on that.
Yeah, it's a big challenge. We do auto refinance loans, and we have not really, it's been hard to scale it because the client base that we focus on often is pretty underwater with their car. We had to raise our loan to value ceiling to 130%. And even then, we were having a lot of folks who couldn't meet that criteria. And in the buy here, pay here space, it's well known that what they do is they inflate the price on a piece of crap car, and then they charge a really high rate so that it is hard to refinance out of it. And then, if they have to repossess it, they can resell it. That is a very big problem for refinancing high interest auto loans.
Thank you. Next question. The new Illinois law restricts lending to 36% on a $200 loan with a 14-day term that restricts the finance charges to no more than $2.75. If one loan defaults, then the lender would need to make 75 full paying loans to get back to the loss principal. Is the 36% restriction too low?
Go ahead.
There are not a lot of $200 payday loans made. Average is 375, but most loans are for more than 300. And frankly, there are very, very few loans that are only outstanding for 14 days. That's really rare. And in Illinois, that's pretty rare too. Most loans were payday installment loans, title loans. Typical borrower was repaying more than triple what they received. So could a lender operate only earning $2.75 and be profitable? Certainly not, but that's not what's happening. We don't see many loans out for only 14 days. We don't see many $200 loans. So I think thinking about this as a 14-day business model does not match reality because in states that have detailed reporting, roughly 97% of loans go to borrowers who have 3 or more in a year. So thinking about this as a 14-day product is not representative of the business model.
Yeah, what this type of reform does is it forces people lenders to switch from a model where the loan is meant to be paid back in 2 weeks to an installment model where the payments are spread out more affordably over a year. I mean, the whole 2-week concept is designed to trap people in debt, because if you can't afford $300 today, the chances that you'll afford $330 in 2 weeks are very, very low. Mm-hmm. And so if you start charging 36% on a $500 loan over 12 months, now you're starting to generate some more revenue that can cover your costs. I just don't think that, you certainly can't do 2-week term loans at 36% profitably, but the idea of a 2-week term loan is of questionable morality, or at least feasibility, if you intend to do it in a way that doesn't trap people in a debt cycle. So it does require a shift in business models, but to Alex's point, that seems to be what happens naturally as a result of these legislative changes. And also, it should be noted, Congress has capped the interest rate on loans to active service members at 36%. So the argument is, if it's good enough for active duty military, it should be good enough for American citizens.
Absolutely. We've got about 1 more minute left, so we'll answer one more question. We still have several questions in the Q&A here, so anything that we're not able to answer now, I will definitely get these over to Andy and Alex, and we'll get them answered for you as soon as possible. Thank you so much for these very thoughtful questions. When creating jobs through weatherization, who benefits from those jobs? Women have borne the greatest burden of COVID job loss. Will green building, green restoration benefit women?
Well, it will if you do it right. And that's why us being a nonprofit mission-driven lender is so important to operate in the space. One of the things that we will be focusing on is steering business to minority and female-owned contractors. And a lot of nonprofit lenders, although we don't do business lending, a lot of them do. And they focus on minority-owned and female-owned contractors. That is absolutely a policy issue. And we need to make sure that the Biden administration keeps that in mind, so that all the job gain doesn't go to the people least in need of it, or who least suffered during COVID. That's an excellent point.
Thank you. And I think that's all the time. It is all the time that we have for Q&A. So thank you for this wonderful, very interactive webinar, everyone. So again, if you had a question in the Q&A that wasn't answered, I will get those out to Andy and Alex and get them answered for you. Here is our contact info, or Andy and Alex's contact information, and ways that you can reach out to us, as well as follow us on our social media platforms, Twitter, Instagram, LinkedIn, and my email address is aisha@capitalgoodfund.org, and that's AISHA @capitalgoodfund.org. So if you have any additional questions, please feel free to email them to me, and I will get them over to Andy and Alex if I can't answer them myself. So thank you once again for joining us. This has been wonderful and so enlightening, and I look forward to doing these, and I can't wait till the next one. So thank you all, and enjoy the rest of your week. Thank you.
Thank
And
you,
thank
everyone.
you, Andy and Alex.
Great,
Thank you,
thanks, Aisha. Thanks, Andy, and great questions. That's
Yes.
terrific. Thank you.